All right, so welcome everyone to this webinar. This is a very special treat today as we get to hear from the two real estate titans in New York City about what they're seeing now and what they predict for 2022. My name's Phil. I'll be the moderator. I'm the founder of LeaseBreak.com, the marketplace for flexible leases in New York City, short-term rentals, sublets, and lease breaks. I've also been a real estate agent for 17 years. So let's talk about the three esteemed panelists. These are some of my favorite New York City real estate experts. First, we got UrbanDigs co-founders Noah Rosenblatt and John Walkup. They have an incredible data analytics and market insights platform for real estate agents, which many of you subscribe to. I really believe that adding value to buyers and sellers is really the name of the game as a real estate agent. And there's no better way to do it than having access to the data that Noah and John are pumping out. And then we have Jonathan Miller, another real estate data icon in New York City. Jonathan Miller is the CEO of Miller Samuel. This appraisal and consulting firm has been around, get this, since 1986. And he doesn't look a day over 30. You don't get that kind of longevity in New York City unless you're constantly adding tons of value to the savvy New Yorkers. Not only does he run a fantastic appraisal and consulting company, but his real estate market reports are a must read. One quick story about Jonathan. I told him I would embarrass him during this webinar, but in 2008, when things were insane, brokers had no idea what was going on. The market was terrible. Agents were freaking out, not quite jumping out of windows, but close. It had that vibe. He came to our office with a series of charts and graphs and explained what was going on. And it was so invaluable. And I immediately was able to go to my sellers and buyers and get them off the fence. And it led to immediate benefits to my business. I'm forever grateful, Jonathan. So thank you.
Oh, thank you.
And it goes to show you the power of data. And that's why all three of these guys need to be on your radar. So with that as a backdrop, let's jump right into it. So when you all registered, we asked you to write in a question. And by far the most popular questions had to do with pricing. So let's discuss. First, we're going to start with you, Jonathan. So if each of the panels could have a crack at these type of questions, but they're related to pricing, and they are, how far did New York City prices drop? How much did they recover? Where are we now? And where are we headed? So Jonathan, if you want to take a crack at that. That's sure. Jonathan Miller. Yeah.
Right. Sure. So just a disclaimer is that my crystal ball is held together with duct tape when we talk about the future. So when we think about pricing, think about sales and rentals separately, because the rental market at one point was down 25%, and all the millennial college graduates in the suburbs moved to the city, right? And the purchase market, I think, at its worst was down between 5 and 10%. And the reason why it was a lot less than the rental market is because the damage from the economy, the pandemic economy, really punished lower wage earners much more than mid and upper tier salary types. So as a result, renters tend to be lower wage than for sale, not exclusively, obviously. But what has happened through now is that the purchase market and the rental market in aggregate are seeing some parity with 2 year ago levels, but it's not that straightforward. So the idea is that when you look at the rental market, you're looking at prices over the last year up about 18%, and in the what I would call doorman type buildings, sort of the upper half of the market, and the lower half of the market, prices are up a couple percent on a year-over-year basis. If we compare against 2 years ago, which I think is more what we should be doing, because a year ago was distortion. The year-over-year stuff we're maybe a month or two away from like getting out of that distortion, in the coming, because I always love year over year to remove seasonal. But right now, rents are at the high end, the upper half of the market are really up a lot relative. And so when you talk to people that are like looking at REITs, or they're not looking at like the small business owner that owns a Walkup with a rental, it's like two different planets in terms of how they're performing. It's really night and day. On the purchase market, this last third quarter was the most sales activity in the more than 32 years that I've been tracking the market since, the beginning of time, it feels like, where I physically put those numbers 32 years ago into the same spreadsheet I'm using now. And what you're seeing is, by far, the market is still heavily polarized, where the upper half is outperforming the lower half by a fairly big margin. I'm not saying that $50 million sales are flying off the shelves, but what I'm saying is that on a year-over-year basis, we are seeing the upper half of the market is probably up, 5-10%, but the lower half of the market is down, in the neighborhood of 5%. So,
Jonathan, are you referring to, just to interrupt, are you referring to prices when you say down, or volume?
Prices. So I'm sorry if I wasn't clear. So in terms of units, rental activity is starting to decelerate. New leasing activity is slowing down. It's been a year of above average activity. And so it's starting to slow down, but prices are still rising pretty significantly in terms of what people are actually paying. On the purchase side, we're seeing about 8% of the market is going to bidding wars, and that's above the normal sort of stable range of 5 to 7%. But it's nothing like the 31% market share of bidding wars we had in 2015. So that's my long rambling answer.
Great. Thanks so much, Jonathan. Let's just hear from John Walkup. So John, if you don't mind chiming in and give us your thoughts on how you see things, and maybe you could specifically also address negotiability rates and where that is now, where that was, maybe where it's going. Go ahead, Jonathan. Go ahead, John.
Yeah, sure. I mean, I completely agree with everything that Jonathan said. And I think, looking at the market in terms of, what the pandemic did to the economy is a really handy prism, because certainly he's absolutely right that when we look at the recovery in the rental market, it really started with the larger units. The more expensive units recovered a lot faster. And that could be due to, number one, they're higher earner people in it, but it also could be the fact that, people are interested in more space generally. And I think that's one of the things that's also pushing this market forward, both the rental market and the sales market, is that desire for that Zoom room, the remote school room, that just a little bit extra space. You need that one more room to and I think that's what's driving some of the demand that we've seen here. And I think a great way to sort of understand what that demand dynamic looks like is to kind of look through the frame of, or rather look through the lens of listing discounts, and get a sense of, how much are sellers, once they put it on the market, once they understand what's trading in and around what their market price should be, well, are they getting close to it? And, if you look back to where we were in November last year, Manhattan as a whole, you look at sellers were probably getting roughly about 92% of their ask. They're taking like an 8% discount, which that's fair. I mean, we were coming out of the pandemic. It was still pretty early in the recovery. The buyers weren't totally back. And now we fast forward now. I mean, we're looking at Manhattan overall like 5%. So that listing discount has shrunk almost in half. If you're looking at last ask, it's almost 3%. And that's, so you can certainly see that even though, you talk about there's differences in how the price recovery looks depending on which segment of the market you're in, but just generally as a whole, there's been an enormous drive in demand that's really pulled the listing discount down from, in Manhattan, close to 10 to almost 5 now. And in Brooklyn, really the market there just actually never slowed down. So you look at that Brooklyn recovery and you look at the listing discounts there, they were probably 5% at the worst we saw during the pandemic. And then, now fast forwarding to current, there may be 3 on a median level across the entire borough. And if you're priced right, you're probably actually looking at selling above the ask. So, that's sort of my nutshell answer here, Phil, is, you want to look at how pricing is doing. What's the recovery? I would suggest looking at listing discount. And I would say that sellers are getting a lot more now than they were a year ago. And if they're priced right, they're pretty much getting their full ask.
Great. Thank you so much, John. Noah, so how do you disagree with these two fellows over here? I'm sure you totally disagree with them. No, but
Well,
seriously, I'd love to hear, I'd love to hear your thoughts. But I do want to say, you and I had a really interesting discussion about volume, which always fascinated me because I always was assuming, and some other brokers too assume, man, there's just no inventory. There's no inventory out here. I keep saying, and you're like, no, Phil, that's not actually what is going on. And you talk about volume, and so if you could just speak to that, I'd love to hear your general thoughts and also your thoughts about inventory.
Yeah, well, I mean, we have inventory. I mean, it's down. I mean, we have 6,500 units on the market. We were at 9,600 units last fall when at the worst of it kind of thing. We've been going down, but I mean, we're not historically. I mean, we had 3,000 units in 2014, 15, 13, 14, 15. We had like 3,000 units. I think we dipped below that. That's low. That's low. I mean, 6,500. The problem is that the sellers have a misconception of where the market is. All right. I like a couple of things. Jonathan Miller said deceleration. We are definitely decelerating. So like to answer your original question, I think we fell. All right, the broader market. First, the broader market, because luxury new dev do their own thing. The broader market fell 8 to 12%, in my opinion. I think Jonathan said 5 to 10. So if I disagree with him, I think it fell a little bit more. That's basically we're 90% overlap over there. So if we fell 8 to 12% for the broader resale market, that doesn't mean, some people got pockets of good deals. Some people got 15, 20% off when there was no market and there was no liquidity and there was no bids last spring and summer. That was the time to buy. But overall, sellers chose not to sell. That's why, ultimately supply came on after the reopen, bounced to 9,600. We came straight down to 6,500 because we recovered. We recovered that 8 to 12% discount. Okay. If we fell 8 to 12%, we recovered that 8 to 12%. However, I think that recovery peaked in the summer. So the deceleration that Jonathan was talking about, I completely see it. I think we went too far, too fast, too far. We were doing 1,800 deals a month in April, in May, 1,700 deals a month. That's crazy. Like we usually in an active season do 1,100. Now we're doing 1,300. So like, I like to use that analogy that if Manhattan real estate travels at 30 miles an hour on an average, and like some active seasons will get to 35, some slow seasons will get to 25, a little below. We went down to 5 miles an hour in COVID, and then we shot up to 75 or 80 in summer, and now we're back down to 50. Right. So it's like we're still speeding, man. We're still going 50 and a 30, but we are decelerating. So I think like when I look forward, I want to answer your question looking forward. I think that prices have done the first recovery cycle, and we're literally in one of the dips right now. You can have an uptrend over time, and I think this market is in the process of a secular uptrend over the next 4, 5, 6 years. We'll get into that. But I think we're now in the process of dipping off that first wave up because nothing goes in a straight line forever.
I'll just give, if I could just jump in just to add on to what these gentlemen said is, I look at, Manhattan specifically, relative, we're the outlier, this market relative to the outer boroughs and the suburbs. And I've been describing Manhattan as late to the party. And I think, one of the basic reasons we were late to the party and we're seeing the boom this year in the suburbs are cooling, even though elevated activity, but they're sort of tortured by lack of supply much more severely. We don't have that issue here. We're still a higher inventory is not bloated, but there's product for brokers to sell that their counterparts in the suburban markets don't have. And by the way, the whole country is very much in the same boat. I guess the point I wanted to bring up is, and this is more of a sort of a stepping back a little bit, is that you have to think of, when you think of inventory, you should think of it as a living, breathing organism. Take the new dev and new construction, take that out. That's like 10 or 15% of the market. So you have the balance. Think of that as this living, breathing organism. And the reason why I describe it that way, it's about people in stages of life. They're downsizing because they're empty nesters. They're aspirationally, increasing. They got a big job, whatever. And so there's this movement, that those properties come on the market. The problem is that we threw, mortgage rates at this and created this massive distortion. Mortgage rates are at 5% in 2018, fell to just above 3 before the pandemic, and then another percent after that. So you're throwing this insane fuel on, already lean inventory, and you get these distortions like 10 to 15%, 10 to 20% price growth in the suburbs. In many ways, that's a sort of the optics that we should probably be thinking about with Manhattan as we sort of climb out of this over the next year or two.
Yeah. One question while I have you guys, and it's kind of a fun question, but we have like the best data guys in New York City for real estate. So I have to ask it. I'm pretending that I'm sitting in the audience. When will prices exceed the 2015 peak in your best guess? No one has a crystal ball. I know that. But if anyone's going to guess, you guys are. Is it 2022? Is it 2023? 2024? What's your best guess?
We're not far
right
off that peak now. We're 10, 15% below that peak right now.
So 2022?
We're no. It'll take a few more. It'll take another more years because we're probably going to go up and then down, a little bit up and down like that. I would say 23 or 24.
If I could put if I'm going to put my future goggles on here, I think everything that Jonathan says very prescient, and I would sort of follow on, which is that we are seeing, you mentioned this deceleration. We are seeing that a little bit, where are we seeing it? We're kind of seeing it in the core sectors that started the recovery. We're seeing it in the under million sector in Manhattan, and same in Brooklyn. Those are a little bit slower. Manhattan was a little bit slower than it was last month in that sector, especially the 1 to 2 million under 1 million condos. And Brooklyn co-ops are a lot slower. Not a lot. They're a little bit slower than they were a year ago. Which for Brooklyn, anything slower than it was is sort of like, whoa, what's happening? So okay, take a bit of core deceleration, throw on top. You have inventory still coming on at pretty hefty paces. So you've got a little bit of slowing. You might start seeing a buildup of inventory. And honestly, I don't know how many of the sellers today are actually trying to just, have their offer lifted because the market's great, or they actually have a real genuine need to sell. And I there's no way for me to know that except maybe track off market in a couple months and see what's real, what's not. But I think we're coming to a point where we have the market returning eventually to seasonality, which means the winter is probably going to be generally a little bit slower than it was last winter, just because things are returning a little bit to normal. We have foreign travelers starting to come back as of yesterday. People are going to be traveling for holidays. So you have a lot of the human activities that were paused return, which is going to just slow the market. That's natural. So if you throw on top of that a deceleration of buyers and an added inventory on top of the seasonality, you might find yourself at a point where the market sort of takes a breath. And I think, to get to your question, Phil, what does that look like for prices? I think to Noah's point, it's going to take, I don't think it's going to be 2022. I think it's going to be 2023, 24-ish that we start to see prices meaningfully. Now that's, of course, assuming everything goes A-okay around everything else, that the economy returns, that the Fed doesn't make a mistake and jack up rates too high to crash everything. Right. So, it's a fine line we're walking, but I think it's going to take some time. And frankly, I think that's a good thing for Manhattan real estate. I don't think you want to see prices go up too far, too fast.
Right. Jonathan, I want you to answer this. Jonathan, I'm going to have you answer this question about when do you think prices, but could you just add into that your thoughts on inflation and rising rates and where that all comes into play?
Sure. So make no mistake, I think there's been too little emphasis on how low rates have really fueled this coming out of pandemic or coming out of lockdown surge in activity nationwide. I cover three dozen plus housing markets across the country, and they're all the same. Massive surge in activity over the last year, record prices, and chronically low inventory, right? So even if rates edge up, I look at it, about 50% of people in the US have a mortgage, have a rate of 4% or less. So I think 4% is, I don't know if it's the magic number, but I think that's where we start to really see like volume turn off, at least temporarily, and till people sort of adjust to the new rates. I'm not of the belief that we're going to go that high. I think most of the inflation risk right now is related to supply chain problems. And I think the only difference is I think that those issues are going to manifest over the next year or two, as opposed to some sort of quick resolution. I think that it's going to be a while, and part of that is just because people that have come out of the pandemic are different. They've had time to think about whether they want to work in that same job again, even with an increase, right? So you have all kinds of labor disruption across the US in various industries. And I don't think that gets resolved right away. Not only that, but even if rates rise, or jump, to hit the 4 threshold or, or something even over, I don't think inventory even coming back in will be enough to sort of, cause prices to soften. There's just too much external, like federal stimulus that's going to, and maybe even another round of it, who knows, coming out of Washington. That's coming into the economy right now and probably over the next couple of years. So I think we're looking at a unique moment in time. And to the sort of the peak, again, my crystal ball, I do have one, but it's held together with duct tape, is that I'm looking at more like 2023. I think 2022 is going to be like this sort of grind higher that will continue just because and that's just because rates are where they are, and I think that's going to continue to drive demand.
Awesome. So you heard it here, everyone. 2023, 2024 is when we should see that New York Times headline that that prices have finally reached their peak. Okay, so let's move on. Yeah, go ahead.
I'm gonna put my hand up because I think it's interesting. There's a lot of stuff in there, and I don't want to belabor the point, but I think to go back to one of the original things that Jonathan said, which is that you look at how the market's sort of bifurcating, and you have what's happening in the upper segments different from the lower segments. And I think that if you look at those luxury units, anything over 2 million, 3 million, 4 million, I would say the majority of those 60% plus do not have a mortgage, and they are cash-based transactions. And if you look at Manhattan as a whole, I mean, roughly 65% of the market has a mortgage. It's much smaller than the United States as a whole.
And I think 55% right now.
55%. So, and I think what you're gonna find, Phil, is I think you're gonna see, because of that, I think you're gonna see average price, because the dollar volume and the number of transactions luxury is smaller, but the dollar volume is massive. I think you're gonna see average price move up quickly. But I think you're going to see medium price, which is a much better measure of the market because it filters out some of the craziness. I think you're going to see that sort of be a little bit more stagnant going through 2022.
Awesome. I think one other thing, just to add on top of what John's saying, is I think that the international component, with yesterday's ruling, I think that is going to be a much bigger factor next year. I think the dollar is still too strong to really have some sort of, tipping point of massive surge in international. But international is below long-term norms in terms of market share. So that's an upside. And then on top of it, corporate America calling people back, which was supposed to be September or October, but the Delta variant, which is why summer sort of cooled off, in my view. It was this whole recovery from Manhattan was predicated, in my view, from vaccine distribution earlier in 2021. And then when the Delta variant came in, it caused some questions, and I think sort of leveled or cooled things off a little bit as a factor. I think going forward, we have upside with corporate America coming back, not 100%, but maybe 60 to 80%. Which in central business districts like Fidei and downtown Brooklyn and Midtown, that's going to really hit the rental market with another level of demand and breathe oxygen into street level retail, which I think helps the purchase market as well in terms of sort of projecting. Manhattan has an optics problem. It's still, it's like cable news panning over Times Square. That's the image, and not, what's happening on the Upper East Side or Upper West Side or, neighborhoods of Brooklyn. And I think that's just going to be, I think corporate America, that's really going to sort of pull people back into the market by having a firmer understanding of your relationship between work and home.
Yeah, absolutely. Thank you, Jonathan, for those thoughts. So Noah, Jonathan did mention supply chain in one of his responses, and there's been a lot of talk about supply chain issues regarding the cost of materials, how hard it is to get materials, even basic appliances and furniture. Any sense as to how these supply chain issues could affect renovations? For example, maybe unrenovated apartments are lagging in this recovery, or anything like that? Any thoughts on that?
Yeah, I mean, everything that you would think is logical about this is happening. Unrenovated units are not enjoying the recovery as much as renovated units are, because buyers are very, very well aware. If I buy an unrenovated unit, I am going to have to deal with procuring all of the materials I need, as well as procuring the contractor and the labor, and all of these issues that you're talking about that Jonathan laid out is very real. Very, very, it's scary. It's, when you look at what's going on in the ports and the congestion in the ports, there's infrastructure and logistical reasons for it. There's regulatory reasons for it. I was trying to read up on this stuff, and it's really kind of eye-opening how those things work, how that whole system works. And it's all broken down right now. And I think Jonathan's right. I think you're going to see it over the winter. I don't think it's really hit yet. Labor is a big issue. Good contract. It's getting expensive. So everything is getting repriced. So when I looked at the data, John did a piece on this data of renovated units. It's not easy to do. We got the RLS data that does it, but we also have to look at the listing descriptions and stuff like that for keywords. It showed that renovated units got hit, but then immediately recovered very, very, very quick after COVID, and are kind of doing very, very well. Whereas unrenovated units just never did anything. They just kind of stayed down. They never even recovered. They're just kind of flatlining over there. I think the same religion is kind of happening with smaller units. Like there's a force out there that's kind of changing our marketplace and changing the things that we're used to seeing. Smaller units used to sell great. And now there's just not the demand for smaller units that there was because of the need for bigger space. So I don't think this is going away. I think this is something that's going to be it's almost like this market changed, and we have to adapt to the fact that it's now a changed market. How much of renovations, how much a new kitchen, a new bathroom might have to be repriced. You know what I'm saying? This was a market where you put 200,000 to a renovation, you almost got the 200,000 back before this. Like, do you get 250 now? Do you get 275? Like, I don't know. So
Jonathan, thank you. No, Jonathan, I can tell you had some thoughts on that.
Yeah. So first of all, the way to think about, in appraiser parlance, it's called contributory value. So how much does a renovation add to value? And so, there are periods of time where it might be 50 cents on the dollar. You put, 200 in, you get 100 in value. There's, because it's not supported in the market. And then there's other times where you put 100 in, you get 200 out of it, or, and we're in one of those periods where there's a premium for renovations and not dealing with, the supply chain stuff that Noah's talking about. Totally agree. The one comment I'll make about, I disagree a little bit with the more space, like buyers want more space. I don't completely disagree, but I just want to make a point, is that what we've seen, and it's been impacted in the median price and the average price, is that the skew towards the upper half of the market by nature has larger apartments in it, and higher price. And so I think part of the larger sort of space argument is because in aggregate, there's been a shift in the mix. I'm not saying that there isn't more of a demand for larger apartments than there was pre-pandemic, but I think it's exaggerated a little bit because in the mix, you can see it sort of playing out that way. Just food for thought.
Interesting. So there's just more product,
larger product.
Yeah.
And so when you look at it in bulk, it actually does skew median as well, because it's enough of it to have some sort of influence. But again, I don't disagree that there's been this trend towards larger. I think it's probably exaggerated because of the shift in the mix.
You're talking a little bit about spacing. Why don't we talk about the age-old question of outdoor space and how you value outdoor space? And it's something that I always found interesting personally, but in the age of COVID and kind of post-COVID, are appraisers and the market valuing outdoor space differently? Noah, did you want to start with that and take a crack at how you would value outdoor space, and then
Yeah, is this
Jonathan,
me
I'd love to hear
versus
your thoughts.
Jonathan Miller here? Is this like a battle of the,
Yeah.
Yeah, absolutely.
Okay.
I'm trying to
We've
get a
done this
little fight going.
before. We've done this before. I mean, outdoor space, this is one of the trickiest things for agents to kind of master. I think a lot of it has to do with utility of the outdoor space. You have to think about a utility. If you got a Juliet balcony, if you got a small little balcony you can barely put a chair onto, I mean, don't start asking what is this thing worth? You know what I'm saying? The way I look at it is slightly different from Jonathan's. So I'll just explain how I look at it. First off, a balcony, let's just say a balcony. You got a balcony in one, you don't have a balcony in the other. 40, 50 grand. You know what I'm saying? Like, I don't know, there's something like the 60 grand, like something give or takes $10,000, $15,000, call it a day, get out of it. Now you got like a garden, small terrace, right? You got like a 100 square foot or maybe like 150 square foot small terrace. I like to look at the interior square foot and then add on tiers to that based on what type of terrace we're dealing with. So like, for example, let's say I have 1,000 square foot condo. And let's just say it's like a 1.3 million, whatever it is, 1,000 square foot condo, right? It has a 100 square foot terrace. I would say add on 100 to 150 a square foot. That little 100 square foot terrace is worth 150, 100,000, 150,000. Now you got like a mid terrace. You got like a 250 square foot, 300 square foot terrace, right? Pretty good. I would add on $200 to $300 a square foot. So now that terrace is worth $200,000 to $300,000, right? If it was a 2,000 square foot apartment, it would be worth double because of the premium that goes with the larger apartment. So I'm looking at the interior. And then finally, with a large terrace, like think a penthouse, private, rooftop, 1,000 square feet, garden, river views, beautiful utility. Like you can get up to $500 a square foot, like $300 to $500 a square foot, depending. That goes up based on the utility, the renovations, the views, because it's so different, you know? And that's kind of how I approach it. So I know it's different than Jonathan's.
And Jonathan, before we get to you, just know a quick question. Are you seeing that people are valuing it differently because of COVID? Is that showing up in the numbers that people are valuing outdoor space differently?
You know what? I haven't done the numbers on it, but I have to think in this case that buyers are valuing outdoor space, or at least apartments with outdoor space, at a more premium in today's market than it was pre-COVID. But I haven't looked at the numbers recently. I apologize. I should have come prepared for that, but I didn't.
No worries. Jonathan, so what about you? How do you look at outdoor space?
So I take a different approach. I look at it as whether it's a balcony, a patio, a terrace. I look at its relationship to the apartment that it's a part of. And so touching on what Noah was talking about, if it's 1,000 square foot apartment, then and it's in a market where 1,000 square foot apartments go for $1,000 a foot, just to keep it simple, versus 1,000 square foot apartment where the price per foot is $500 in a given market. We look at the outdoor space as relational. It's a proportion of the interior space. So for example, renovations, view, or not renovations, but view where, hey, you got a view of the park. The reason why that balcony or terrace is more valuable, inherently is because it's part of this apartment that's of this value. But then we look at generally a range of 25 to 50 cents on the dollar. So if the apartment's worth $1,000 a foot without a terrace, it might be worth $1,500. The terrace itself might be worth $500 a foot, or 50 cents, 50% of the 1,000. And Noah's exactly right. Like the proportion, like the functionality, like you can have a wrap terrace that's 3 feet wide all the way around the penthouse versus the same square footage, a big rectangle from the living room. One's maybe towards the 25% or 25 cents on the dollar, and one's more towards the 50. To be honest, in our practice, at least right now, and I know it's logical to think that, but I'm not seeing like, it's 60% or, like I'm not seeing a higher premium. I think it's more that the apartment itself is, maybe being like, I'm not seeing the relationship change. It's more maybe the premium placed on the apartment itself that's sort of driving the price of the outdoor space higher. This is a method that I sort of came up with like 25 years ago. And it, I have a blog post about this that to this day is one of my most heavily read pieces, because I basically talk about this and how to approach it. Don't think of it as a formula. Think of it as the formula as a starting place, and then you have to add all the stuff Noah's talking about. Especially the utility of the space itself, how usable it really is.
The formula gives you like a good guideline, like a good guidepost, right? And that's a starting place. Yeah.
Yeah.
Great. Okay. Well, thank you so much, Jonathan and Noah, for that. So John, Walkup, let's talk about foreign buyers, because it's really interesting. New York City real estate has recovered so much without the help of foreigners, and they do make up a meaningful part of the market. So when do you see foreigners really coming back into the picture, and to what extent do you see foreign purchasing helping to, say, sustain the recovery from this point on?
Well, Phil, I assume we're talking about foreigners as in non-U.S. citizen foreigners, correct? We're talking about, okay. So I think there's a couple reasons why, if you're a foreigner, you want to own an apartment in Manhattan. The first is sort of as a like a pied a terre, or a place to live, which is I want to spend some time in Manhattan, go to the shows, whatnot. That's coming back, right? Yesterday, I think, is the first day that the travelers could come in with proof of vaccination, including AstraZeneca, the different ones. So I think that's gonna really, I don't want to say it's gonna open the floodgates, but it's certainly gonna bring in some more customers through the door. The second reason, and I guess there may be three reasons. The second reason is sort of that store of value, which is like, I would like to buy something that I can have and hold, and I think I can earn a decent return on it. And I don't think that has come back yet. I think cap rates are still very low. And I think, as Jonathan said, yes, we have seen some rental rates recover, but I don't think until we see businesses coming back and that ground floor retail really getting full swing with the shows and the restaurants, everything back in sync, I don't think you can reasonably expect to buy, and these are 99% plus condo purchases, because it's realistic what they can buy. I don't think you're going to see a sort of a net profit on your investment for at least a few years from purchase, based on the realistic scenario of what the economy looks like now, what those rents look like. So yes, you could certainly have a place to enjoy, but I don't think you're really going to be earning any kind of meaningful return on it. If you look at that sort of nebulous third reason, that's more sort of like almost like it's like a safety deposit box, which is that I'm buying this piece of property worth millions and millions of dollars in the sky because I want to prevent government confiscation. And I think what happened in Cyprus back in, what was that, 2014? Gosh, I'm dating myself. That was a bit of a game changer. The central bank reached in and just took money out of deposit accounts. So purchasing a piece of Manhattan where that can't happen was a great alternative. And I think now you have the cryptocurrencies, you have a lot of other things that are vying for attention, for sort of that non-confiscatorial attention. And I think that factor is really not in play. So if you look at these three reasons, I think you got maybe one that's come back. I think the other two are the third one's probably not going to happen for a while. And that second one about earning a return, I think you're going to have a very long runway to see that. So if you're in it for the long term, yes. But generally speaking, as of yesterday, I think we're going to start getting some more customers through the door. When is it going to make a meaningful dent? I'm going to go back to the pricing thing, and I'm going to say probably not until 2023. I think it's going to take at least 6 months for that whole travel thing to sort of settle down. I think it's going to take another several months for those deals to sort of make their way through the system, buyers to come in, kind of get interested, and actually pull the trigger. And I think you might start seeing a percentage of foreign buyers start ticking up maybe toward the end of 2022, but certainly 2023 would be my guess.
Just to Phil, to sort of add on to that. So when you think of the condo market as sort of the most popular form of ownership, unlike co-ops, for international demand, in 2013-14, based on survey data, condos, about 30% of condo demand was coming from international. Now it's about 9%. And so let's just say it doubles, which seems a reasonable with this. So you're up to like 18, right? So long-term norm is like 20-25 in condo. In aggregate, it's more like 15 when you throw in co-ops and townhouses. And we just have these periods of time where, like, '06 was this, I called it the Irish carpenter syndrome, where, carpenters are buying $1 million condos in Midtown because the currency discount was like, they were getting like a 40 or 50% discount against the euro. And then we had that in like 2013. So it isn't like, I don't see it as like this sort of macro cycle thing. The idea that it's happening, I think, is a plus, but it doesn't infer that it's going to be some sort of boom. It just infers more upside to the market in terms of a larger pool of buyers. And I agree with John and Noah completely that I think it's going to be a couple of years before there's really a rate of return that makes sense to investors, but some may not care. It may be just a move to safety.
Thank you, Jonathan. So Noah, let's just go to you, and then we're going to go to our speed round. This will probably be the last question before that. So we just talked about foreign purchases. And I'm curious, what else are you, Noah, looking at? Other market drivers, things that you're thinking about that could play a meaningful role next year in 2022 that would affect pricing, perhaps the volume of transactions. What are you keeping your eye on? I know you talked about ground floor retail, I think, is something, but what are you thinking about? What are you really keeping your eye on?
Right. So again, I think we're in the early stages of a secular recovery. Probably something similar to what happened between 2010 and 2015. So we're at like 2010 right now, and we bounced off those lows from the great financial crisis. Well, we bounced off the lows from COVID. The first and foremost, the biggest thing is the Fed, $20+ trillion. We talked about 1.2 trillion in the infrastructure package coming. That takes time to funnel through the economic system, folks, right? The immediate impact of that 20 trillion being printed globally by the Fed's central banks is that there's a massive search for yield. Okay, they're bringing rates down real. They're trying to create a reflation. So all that money has two effects. It has an immediate effect on asset prices because too much money is chasing asset prices, and that's why you see things do crazy things, right? And there's a hell of a lot of liquidity there, right? And then down the road, that fiscal stimulus is going to go through the economy. So when I look forward, there's a lot of liquidity that's yet to go through. That's the biggest thing. Then you got tourism. We're not back. We're underutilized, or I like to say we're not at full capacity, is what I like to say, right? If we're an octopus, we got 4 tentacles instead of 8. So we're kind of limping along, but it's amazing we did the recovery we did. We don't have tourism back. The commercial sector is going to be a driver, right? It's not back. It's not turning around yet. Maybe it's showing signs. The foreign buyers, there are foreign buyers coming back. We are in the process of foreign buyers coming back. Everyone I talk to is telling me that they're hearing things, but it's not anything meaningful yet. It's just like it's turning around, right? So when we talk about meaningful discussion, we need that to come way, way, way back. You got the rental recovery that has a ways to go. You got the ground floor retail. In a city where people pay up for amenities and city living, you need ground floor retail to offer that city lifestyle that people want. The foreigners are going to look at cap rates. The cap rates are based on the rental markets and sales markets. So you need something that's going to make it look like a good investment. Okay. And finally, I think is a psychological one. A waning fear of COVID on both a human level, city level, global level. You know what I'm saying? You wake up one day, there are no restrictions. There are no mandates. Okay. We're back to normal, as we like to say. That might seem like it's years away, but that's part of the secular recovery. That's why I think in 2023 and 2024, I think that's kind of what we're going to be, but it's 2-3 years away. But at that point, we're going to be well into it. Let's not forget, Manhattan real estate did not do anything but go down since 2015. We did not do anything but go down since 2015. This housing market nationally, the housing market nationally has done crazy things in the last 18 months, right? We have simply recovered our COVID discount. So I don't think there's anything bubblicious. I think it's a value play. And when I look forward, I think there's a lot of drivers that are going to come online. It's just going to take time.
Great.
If
Go
I
ahead,
could
Jonathan.
just, yeah,
Please.
so a couple thoughts. That was really, really a well presented viewpoint. I 100% agree. One of the things that, when we think about, all the money that's going to be pumped into the economy going forward, that's why I always say now when I speak publicly, I feel like I'm paid to worry, and I'm uncomfortably optimistic over the next 2 or 3 years. I keep catching myself like, what am I missing? And it doesn't seem like, barring a spike in rates, and who knows, right? I think that really will change things dramatically in terms of turning off the garden hose, so to speak. The one thing that when we think about where we're going, I'm looking at it as commercial. When we look at the segments of the market, and retail is critical for this comeback of investors. I think that's really critical. But retail needs the office workers to come back so that they get the oxygen, especially in sort of central business districts. The problem with that is that Zoom is never going away, not in our lifetime, right? So what's going to happen is you're going to see, at some point, you're going to really see a correction in commercial office lease, because it's not that they're going to be empty, it's just going to be cheaper. And you can already see that happening. That's a reality. And the commercial world won't talk about that, but that's a reality. So you're not going to have vacant offices everywhere. You're going to have them full, but they're going to be at lower rents. And after having like 3 decades in the driver's seat, it's hard to capitulate to market forces overnight. You have debt service that's predicated on certain, income streams. And I think commercial, but that to me, putting aside the pain and suffering, to me, that's sort of exciting in the sense of, what we saw in the rental market was this sort of renaissance of youth, making the city a little bit more eclectic, and instead of sort of luxury to the 15th power. I think it'll be a little bit more mixed. And that's I think a good thing for the city. The city is going through this sort of weird, like, rediscovery, reinvention process. And that's why I agree with these guys. Like, I think the next couple of years are going to be pretty good for the market.
Great. Thank you, Jonathan. So optimism. I love it.
So unlike me.
Let's move to the speed round question. So try to keep your answers to like 1 or 2 minutes max. John Walkup, let's start with you. You kind of covered this a little bit already, but a lot of people talk about, is seasonality out the window? Is it gone? Because of COVID, there's no more seasonality. You can't. Is your gut feel, or what the data is showing you as well, tell you that we're going to get back to more seasonality, where list in the spring, the summer's slow, this kind of thing?
Speed round answer: yes. So yeah, I think with COVID, seasonality was completely thrown out the window. The recovery sort of started in, let's talk Manhattan. The recovery started in October, November, gained steam through the winter, and just kept going, powered through the summer. And here we are. And I think, yes, we're going to get back to seasonality, just simply because I think human patterns in general revolve around doing other stuff in the summer and the winter. People like to go on vacations in the summer, and you've got Thanksgiving and the holidays in the winter that sort of divide your attention. So the market has 2 main periods, the fall and the spring. And I think we're going to finally sort of make our way back to those. So I think seasonality is going to be coming back. That's, I don't think, a surprise to anybody.
Great. Wonderful. Let's go to Jonathan Miller for this one. Jonathan Miller, what happened to Zillow? iBuying. They got out of the iBuying business. What happened?
All right. Can I take the over on 1 minute here, by the way?
Yeah. Like, I'm not promising a minute. So first of all, I was sharing this on Twitter the other day. My dad joke, which is the A in Zillow stands for accuracy. And the reason why I said that is because they really overpaid. They tried to accelerate the process, and they ended up in the third quarters where most of the damage was done. And, 79% of the listings in Phoenix that are Zillow, were bought by Zillow are listed for less than they paid for it. So it was just a seismic error. This is something I think agents should really understand, is that when we talk about their accuracy rate, they call it median accuracy, which means that 50% of the time it's within 2%. That's the national accuracy rate, is 2%. So 50% of the time it's within 2%, and 50% of the time it's not. But everybody just sees 2% and said, oh, they're so accurate. No, half the time it's median. It's 2%. And then the other part, because it gets better, is that that's only if the property's already listed. And then on top of that, because it gets even better, if it's not listed, their median accuracy rate is 7%. So that means that 7% of the time, or 50% of the time, they're within 7%, and 50% of the time they're not. So to get from 7 to 2 needs the brokerage community to put it on the market, which is insane to me, because here they are like bypassing their competitor, the brokerage community. And to get to 5 from 7 to 2, they need the brokerage community to price it for them, and then they can get in the ballpark. And I don't think people understand. That just shows what a fail.
I think what happened there also is that they look at traffic rates as well, and they see apartments that are priced well. They'll have 550 likes and saves, and what the Zillow algorithms did is like, let's go for those guys. You know, so they figured they'd go for something where there's a big market for it. So if they ever had to sell it,
right,
whatever.
Right. It's a fail. And what it actually tells you is that sort of the high tech big data space actually needed the brokerage community to price the property so that they could get a respectable accuracy rate. And I just find that to be like one of the most unsung, sort of points of this whole debacle.
Unbelievable. Okay, so thank you for that, Jonathan. Not too bad, a little over 2 minutes, but not too bad.
It was right, painful for me, but that's okay.
Noah, we did hit on this a little bit, but I do think it's important to just directly speak about cap rates and investors. We did talk about the rental market and how that relates, but you're an investor looking in right now. How are you viewing the New York City market right now?
Nah, I'm not. I mean, if I'm an investor looking for a rental return, I'm not. If I'm an investor looking to buy something that I think ultimately will have a great return and I'm buying at a good value, absolutely. But if I'm an investor like looking at a cap rate, I mean, what are the cap rates in Manhattan? They're like 1.5%, 2%.
Yeah, it's insane. The rental market doesn't support it.
The rental market doesn't support it. The rental market doesn't support it. And so if I'm an investor, that's the thing I'm looking at. And I'm like, so until the structural issues that we described, until the market drivers, and until we're back at full capacity, that's a great way of looking at it, guys. Like, we are just not at full capacity. When we are, the investors are going to be right back in it, but the prices will be at a new level because the prices are pricing everything in now. We're at 2019. That's where we are. We're at 2019. Yeah. Done.
Yeah. Thank you. No, great. I didn't mean to cut you off. You had another 10 seconds. No, I'm just kidding. No, kidding. John Walkup, one thing we didn't talk about much at all during this discussion, maybe once or twice someone mentioned the townhouse market. So would love to just get your thoughts on the townhouse market, sort of where are we, what happened during COVID, where are we going, just a sense of what is going on with the townhouse market. Oh, John Walkup, that was for, unless he's frozen.
So
Oh, okay.
Yeah. So the townhouse market in Manhattan is a much smaller segment of the market than it is, say, in Brooklyn. So in Manhattan, it's generally a much higher price point. And yes, we've seen some demand return to the townhouse market, and prices have sort of, started to increase. But, as with the overall market, you really got to slice and dice this to make sense. You've got the under 20 feet, 20, 25 feet, like width has a huge determinant upon price and demand. And, there's just, let me put it in a nutshell. Townhouses have seen a return in demand. Brooklyn townhouses, on the other hand, really the demand for those has just kind of gone through the roof. And we've seen the number of transactions for those just, or rather the price
Are we losing them?
for those just really sort of outstrip those of like say like a co-op. And it just, there's been, am I losing you guys?
Yeah, we
Yeah,
might.
you're freezing a little bit, Johnny. Why don't we go to Jonathan Miller and we can come back to John?
All right, so Jonathan Miller, what is the
Can you
best
hear me?
advice that we're losing you, John Walkup. We're going to go to Jonathan Miller. We'll come back to you.
Okay.
Over here. All right, so
Sounds good.
Jonathan Miller, best advice, buyers, sellers, investors right now. They come to you. I'm sure you get these kind of questions all the time. What should I do? What are you basically telling them? To wait, to not wait? Are you telling people to wait, don't list your home until the spring, list right now? What are you telling buyers, et cetera?
So basically, I don't tell them anything. And what I mean by that is, so my view is I'm completely neutral. And that would be more like what Noah or John would do. I'm like, hey, here's the snapshot right now. That's what I can give you. And then you can make an informed decision. As opposed to, I don't see myself as an advisor. Pretty good teller of dad jokes, but not an advisor in that regard. We'll have people that'll say, hey, do you think there'll be a lot more sales next year, or prices will crash, or or go through the roof? We get that kind of stuff, and we can answer that sort of with data, but we just don't do. That's not how I think of what we do.
I'll do it real quick.
From
a pulse point of view, I think the sell signal was in late summer. The sell signal was in June, July, right around there. It's a buy signal right now from a pulse, meaning buyers have more of an option today than they've had in like the last 7 months, right? And if you go back in time, it kind of hit 7 months, but we were going up then. We were going up to the peak 7 months ago. Like, I mean, that was April at this point. We were hot in April, going into the peak. We're coming down, totally different sentiment. So like, I think buyers right now actually have some leverage advantage versus the summer. Sellers are not really waking up to it. Sellers are in shock how much it changed over the last few months.
If I could just jump into that, since I sort of copped out of my earlier answer, is I think that the slowdown in the summer, and I sort of alluded to this before, but I really think it was Delta variant related, and it wasn't sort of this supply and demand economic sort of thing. It was this external force. And we're already seeing, things pick up right now. So I think that this was sort of a temporary bump, and that's why I'm still pretty optimistic about, going into next year. It's very uncomfortable to talk this way.
Thanks, guys. So wait, now we really have time for only one more question. John Walkup, are you with us now, or are you still frozen?
I was always with you guys, just in spirit.
To hear that. I'd love to hear that. Okay, well, I don't know if you want to finish up your thoughts on the townhouse market, and then the final question really is, and you also alluded to this a little bit, but what are the most significant changes in the way people live and work during COVID that you think will affect real estate long term? Like, are there just a few things that you're like, wow, this is going to be a permanent change from COVID, and it's going to affect real estate for the long term?
Yeah, I mean, I think what we're doing right now is sort of a permanent change from COVID. I mean, we've gathered a group of panelists. Noah's in Connecticut, Jonathan's in Connecticut, Phil, I assume you're in Manhattan. I'm in Manhattan, and we've got people all over. And we've got hundreds of people on from all over the place, and we all came together at a certain time, and we're doing this. And I think that's going to be something that's going to carry on. It would be great to be doing this in person, but that logistically is, thinking back, is like, ooh, that's really difficult to set up. And I think we're going to start seeing a lot more. And I know Jonathan loves his 4-day weekends, so he's not going to be going back on Mondays and Fridays, because why? You can get everything you can get done in your home office. So I think
I don't have to.
Exactly.
Right?
So, and I think that we're going to start seeing, and I think, Jonathan, you actually I don't know if you coined this term, but I'm going to say you coined it because it's great, which is the co-primary. And I think that's going to be. I
coined it.
I love it.
I'm living off the residuals right now. Like, it's
very good. I'm happy to put, a piece of Bitcoin in that jar. And I feel like that's what we're going to be going to. People have their place in the Hamptons or the Catskills or wherever it is. And, you get out of the city for a few days, you come back. And I think it's one way people are going to be achieving that life work balance. And that's really everyone's been trying to do that since time immemorial, achieve that balance. And so this is just another factor that we can consider. Add on top of that, I think you have options for remote school and, in some cases. So if you're sick, you might not necessarily have to miss a day of school for your kids. So there's a lot of this remote stuff I think is going to affect things. And how does that affect real estate? Well, I said this early on. I think people are looking for a little bit more room. So if you're going to have a home office or do something like this in your home, it's helpful to have a bit of space, a bit of quiet. I think it's also helpful for the internet service providers who are, upgrading everybody left and right, and the people that are selling microphones and cameras and things like that. So there's a whole economy that revolves around it, and I think most of that is generally speaking bullish for real estate because you need a place to do it.
Anyone have anything they want to add to that as a final comments?
The only thing I'll add real quick is the way we see the world right now is not the way we're going to see this situation in a year. We're still figuring it out, sorting it out. Corporate America is still figuring it out. But we're not going back to pre-pandemic, in the context of remote. We just have to figure out, I used to say, like in summer, we were at peak Zoom, and then, we're going to end up somewhere in between peak Zoom and the way it was pre-pandemic. And that's what's happening right now. And I think that's going to vary tremendously by industry. Wall Street's already kind of said, well, we want you here 5 or more days a week, long hours, but, people are quitting and looking for other, and so it's going to vary by industry, but all those things have ramifications for real estate. And I think we have, 2, 3, 4 years of this ahead of us. The answers aren't obvious yet.
Wonderful, thank you. Someone did request that John Walkup finish his comment on the townhouse market, and I do want to give you that opportunity because when we look at this seminar, years from now, we're going to be like, oh, John never got to finish those thoughts. So John Walkup, did you want to finish your thoughts on the townhouse market?
In a summary, townhouses have really found a bid here. Manhattan townhouses are a smaller segment of the market, but they're doing much better than they were pre-pandemic. Brooklyn townhouses have, just like the rest of Brooklyn market, really just caught on fire. And I think they're actually outpacing, say, like Brooklyn co-ops. I think that the townhouse market in Brooklyn is exceptionally strong. Just that's really the summary, is that the townhouse market is doing quite well. And now, I think you have to put parentheses around all of these statements by saying, if it's priced right. So you price it right. If it's a townhouse, generally speaking, it's going to move. If you're in one right now, congratulations. You're in a valuable asset class.
All right, great. With that, any parting thoughts? I think we're going to wrap up. This has been a great discussion. I want to be respectful of everyone's time. We're now a couple of minutes after 2. So you could reach us all on Twitter. For Noah and John Walkup, you could reach them at UrbanDigs, UrbanDigs. For Jonathan Miller, you could reach him also on Twitter at Jonathan Miller, JONATHANMILLER. And for me, I'm Philip Horigan at Philip Horigan on Twitter, 1L, 1R. And I think that's it, gentlemen. This has been great.
That was fun.
Really
Thank you, Phil. Thank you, Jonathan.
Thank you, Phil.
Thank you, everybody.
Pleasure.
This was fun.